Ever wonder why some businesses thrive while others struggle to stay afloat? It often comes down to small business owners understanding one critical factor: revenue. Today, we're diving deep into this crucial topic with Pathway Business Advisor Key Dawson and Bob Lancaster, Director of Business Advisory Services, who know exactly what small business owners need to look out for when it comes to tracking and managing their revenue.
So Bob, net income percentage, what is it?
Well, net income is operating income minus non-operating expenses plus non-operating income. Now, what does that mean? Okay. Well, typically, it's operating income minus interest expense. That's generally the biggest expense below operations. And operating income minus non-operating expenses is net income. Now, what is net income? Net income is technically what's left over for the shareholder. I mean, it's also what's required to pay debt. If you have outstanding debt, you're going to pay your debt out of that, at least the principal of that debt out of that. But the shareholder's going to pay himself out of it or herself out of it. And it's what's left over to put in a bank account for future uses. So that's all income minus all expenses, net income.
Okay. So why is that important?
Well, if it's not positive, that means you're operating in a deficit, and over time the company will become insolvent, exactly, and it will not survive.
Yeah. So how do you track the net income percentage?
Well, basically it's the same as you track operating income. I mean, literally the only other expense of any consequence that's going to be deducted from operating income is interest expense, which is debt related. And if it's a taxable entity, you're going to pay income taxes on it. But most smaller businesses are not corporations and do not pay taxes, as it flows over to the owners to pay the taxes. So it has to be adequate to pay all the other bills a company has.
So from an underwriter perspective, why would it be important for them?
Well, it's just another measure of the company's solvency and its long-term viability.
And the debt service is usually paid out of that number. So.
Well, debt service is typically paid out of operating earnings.
Okay.
Because interest is one of the major deductions from operating income.
If you're looking to dive deeper into managing your business finances, or are preparing your business to receive capital, we've got more resources waiting for you online. Just click the link in the description below to explore topics like revenue management and other crucial metrics that financial institutions consider when you're seeking capital to grow your business. Our team of business advisors offers free support to Tennessee entrepreneurs in various aspects of growing their small businesses and taking on new opportunities. As the largest non-depository community development financial institution in the state, we provide lending solutions and educational services to help grow and preserve small businesses. So join us online and plan your next steps with Pathway.